G'day there, investorholics and friends. Today I thought it'd be fun to have a look at the 3 best thematic ETFs that I think will see massive gains in 2021. So these ones I've been watching through 2020, and I think there's still quite a long road to go for these guys, so a fair bit more upside. So stick around, hopefully we can add value to your research and also be entertaining and have some fun along the way. Hey there, investorholic. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, so we're following the megatrends, so looking at what's changing in the market. So the first one here is the ETFs, battery tech and lithium. That one has the code of HCDC. Looking at a market capitalization of 80 million. So I suppose in the scheme of things, that's sort of medium to large in Australian terms anyway. Second one here is the BetaShares Global Cybersecurity ETF with the code there of HACK, which is hack. The market cap here is 358 million. So this one's quite a popular, quite a large ETF. And the bottom one here is the ETFs S&P Biotech ETF with the code of QR. Market cap here of 32 million, so it's the smallest of the two. I think it'd be interesting, so stick around for the quick roundup on these three. Okay, so first up, as advertised, is ACDC. So the ETF aims to provide investors with the return before your fees and expenses that track performance of the selective battery value chain index by holding all the shares that make up the index closely in proportion to the index weights. So ACDC provides investors with access to companies involved in battery technology and lithium mining. So you're looking at sort of areas like electrochemical storage, not just for lithium. So in order to capture the growth for the whole industry, so ACDC is a global portfolio covering multiple regions and sectors and adopts an equal weighted strategy. So I have a bit of a closer look at what it holds, but why would you bother? So I think alternative sources of energy generation have the ability to affect storage and energy, thus ushering in a new paradigm in energy consumption. So I think there's going to be quite a big bit of growth over the next sort of 5 to 10 years as well. In all parts of our life. So you're going to see electrification or decarbonisation, I should say, of the global economy pick up pace, and this type of ETF I think will do well for the next 5 to 10 years at least. Okay, we've got a net asset value of $80.38, trading just above net tangible asset there at $82.89. As we mentioned, market cap of about 80 million. Management fee and a cost recovery fee there, so it's probably one of the more expensive ETFs that we'll look at today. Semi-annual distribution in January and February. Your dividend yield is 1.02%. So there's still a lot of water to go under the bridge here for the battery tech space, and the average investor, we'll get sort of a better read on it, in the next, I think, 12 to 12 months to 18 months. There's still a few things to shake out. So an investment into an ETF like ACDC can spread your risk at this relatively early point in the super cycle. Yeah, look, if there's a bit too much uncertainty in an ETF like this, I think there might be other things to take a look at, and that's kind of why I sort of had 3 ETFs here. But I still think that this one's going to perform quite well over the next 12 to 18 months anyway. But like I said, really understanding the trajectory and how it's all going to work out might still take a little bit of time. If you're keen to do some more research, also have a look at RBTZ and ROBO. So they're the sort of robotics technology type ETFs, so they might be worth having a look at as well. Okay, let's have a look at the holdings. So Pilbara Minerals, Renault, Galaxy, Tesla. So I didn't kind of mention it before, but this is another way to get exposure to Tesla, and I think that's one of the things that's actually driving the performance of this ETF. AMG, Advanced Metallurgical, they're a Norwegian company, I think, from memory. Minres, Levent, Nissan, and Solar Edge Technology. So that's a top 10. Sort of bit of a mixture between Australia and a couple of other different exchanges. Performance since inception has been pretty good. Sort of racked up 24%, but this one hasn't really been running that long. As you can see there, we don't have a 3-year stats yet, and that's because it's really only been running for 12 to 18 months, I think, from memory. So one to sort of keep an eye on and see how it performs. But I think you're definitely going to get some good upswing, and that'll be pushed along by Tesla. It's my feeling, and Tesla's going to push Pilbara Minerals, Galaxy, Minres, AMG, Levent. So all those producers of lithium, it's going to push those ones as well. So definitely one to keep an eye on. So let's take a look at QR, which is the ETF's S&P Biotech ETF, and that one aims to provide investors with a return that tracks performance of the S&P Biotechnology Sector Index by holding all the shares that make up the index closely in proportion to the index weights. So, why we bother looking at this one? So it's diversified exposure to advanced biotechnology. So biotechnology companies focus on research and development of innovative drugs and treatments that use complex biological materials in their development. Biotechnology exposure is very different to healthcare. Biotechnology is a sub-industry of healthcare sector, but has very different characteristics and is better known than its better known pharmaceutical sub-industry, I should say. Okay, a net asset value of $75.44, trading. Trading below that at $70.50. Market cap of 34 mil, as we sort of touched on before. Management fee of 0.45%. Distribution frequencies annually, so you get a dividend in July. The dividend yield is very, very healthy, almost 10%. So I think, if you're looking for dividends and sort of a growth, even though technically that doesn't really exist, this may you may be able to find that in this ETF for a short amount of time anyway. So the companies in this ETF develop cutting-edge treatments that will have applications well beyond the current pandemic, so even beyond COVID-19. So barriers to entry for this part of the healthcare sector are incredibly high. This means that once a company is established, it can grow its market share and profits rapidly. So, you know, Q can be used to give you exposure to the global healthcare sector and sort of, you know, provide a sector diversification via investment in the sector that is underrepresented in the Australian market. So, you know, you can use it to sort of give you exposure that way. You're going to get exposure to companies like Moderna, Acutus, however they say that, Therapies Holdings, Arrowhead, Kodiak, and Twist Bioscience Corp. So over long term, this ETF could produce market-beating earnings. So if you're interested in more research, which we always should be, check out Drug and also Robo. Robo's probably a little bit outside, you know, less similar to this ETF, but definitely check out Drug. Sort of the closest ETF that I could find to do a comparison to this one. Performance since inception, 28%, so pretty good. The last sort of 12 months, we've sort of seen 40% return, so that's pretty healthy. So if you've kind of got into it at the bottom of the market in sort of late February, March last year, 2020, you'd be looking at some pretty good returns already. So I've sort of touched on a few of the companies that we're looking at here. But yeah, I think it's definitely gives you exposure to companies that, you know, you really don't know of in your portfolio, but definitely something, you know, that's could actually create some good returns for you over the long term. Okay, let's jump into Hack. So Hack aims to track the performance of the index and provides exposure to leading companies in the global cybersecurity sector. So the index is the NASDAQ CTA Cybersecurity Index, and it's designed to track the performance of companies engaged in the cybersecurity segment of the technology industry. So, you know, it sort of includes companies primarily involved in building, implementing, and managing security protocols applied to private and public networks, computers, mobiles, devices, and all that type of stuff. So pretty much all the companies in this ETF cover everything almost, I suppose. So, you know, why we bother investing in it? So investing in a fast-growing global sector. So with cybercrime on the rise, the demand for cybersecurity services is expected to grow strongly for the foreseeable future. So, you know, it's a convenient, cost-effective way to access the market for this sector, I suppose. In one trade, you get diversified, cost-effective exposure to global cybersecurity companies in a sector that is heavily underrepresented on the ASX. So, you know, it's kind of why I chose some of these two good returns, but also you're not going to really get a lot of exposure like this on the ASX. You know, you've probably got some current and future industry leaders included in the index here. The fund's portfolio includes global cybersecurity giants as well as emerging players from a range of global locations. So, I mean, especially in this industry, you're going to have quite a rapid, in my feeling, is quite a rapid movement of who's actually on top and the winners, I suppose. So every, you know, 4 or 5 years, you're probably going to have new winners as these guys come up and eat each other, in effect. Okay, so we had a net asset value of $8.82, trading just below that at $8.81. Management costs of 0.67%. You get an annual, semi-annual distribution in January and July. Get my words right. Dividend yield is very healthy here at 11.5%, so definitely if you're looking for some income, well worth checking this one out. So with remote work on the rise and the work from home movement gaining momentum, there's a growing need for strong cybersecurity in the home and office as hackers attempt to gain access to sensitive information on an industrial scale. Actually, you know, what's coming out of Africa and Central Europe and Russia and China and all these type of places, it's quite a scary place to exist in, I suppose. So we all need to protect ourselves. So this ETF could be a simple and cost-effective way to gain exposure to the world's leading cybersecurity companies in one single trade, nice and easy. So, you know, I think that, you know, with the fact that there's so many hackers out there, I think this sector has a strong growth prospects. You know, this ETF could be used to implement a variety of investment strategies. For example, gives you tactical exposure to the global cybersecurity sector, or a core component of a global equities allocation, providing transparency and diversification benefits. So you can use it in two ways. You can use it as a core or satellite in your portfolio. My feeling would be to use it as a satellite, sort of, you know, bump up your overall returns of your ETF portfolio. Yeah, I'd also have a look at ETFs such as Asia, Tech, and I've kind of mentioned Robo a couple of times, but have a look at Asia and Tech. They've also have some good returns associated with them. Okay, so top 10, you're looking at CrowdStrike, Zscaler, Cisco, Accenture, Splunk, FireEye, Proofpoint, Palo Alto, Fortinet, never heard of those guys, and SailPoint Technology. So looks like those top 10, my guess is, are all US based. Definitely the first 5 or 6 are. We've got an inception date for this one here of 30th of August 2016. So since inception, it's done 19% per annum, which is pretty good. If you can compound your investments at 19% for 30 or 40 years, you're doing pretty good. So, you know, if we can get this for the next 5 to 10 years, I think that's good. 3-year return, you're looking at 21%, so definitely has a pretty good outlook, although I suppose that's past anyway, so got to look to the future, but I think the future for this one's pretty strong as well. Definitely worth having a small exposure to. Okay, so the ACDC since inception has done 27%. So 12 months, 64%. So just updating a few of these figures for you guys. The Hack ETF since inception has done 21%. 12 months has done 36%. Cure since inception has done 22%. And the last 12 months has done 34%. So all very solid past history. And I think, you know, my feeling is that you will still see these type of returns. You know, the average since inception anyway, sort of low to mid 20% for the next five years or so. So I think it's definitely worth a closer look. And also, what surprised me is Hack and Cure also pay quite a healthy dividend. So that's another reason to take a close look at these guys. So as always, I hope the information was informative and add value to you guys. So these are the 3 that I think are worth including. I'm definitely looking at ACDC, mainly because I've got a bias to the metals and mining type type things, but I think these other two also could be good to add to your portfolio. As mentioned, I think they're a satellite type investment, so maybe 5% of your portfolio in each of these, and that'll help boost up your overall returns. So yeah, definitely three different options worth looking at anyway. So hopefully it was informative, guys. Thanks. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are, expand your investment horizon, and crack your financial sky. Thanks, guys. See you later.